Hi, this is Ben Graham. Welcome to our lecture on financial crises. Some nice uplifting material here, but some really worthwhile stuff. The most important thing though is don't start this lecture unless you have watched the videos for today and probably also listened to the podcast. So there's a really nice series of Khan Academy videos that are assigned for this week that walk through how currency reserves work, how pegged currencies work, and then how speculative attacks and currency crises work with the example of the Thai financial crisis, right, from 1997-98. And everything we do this lecture about the Asian financial crisis will assume you've watched those videos. So everything in this lecture builds on those. Similarly, what we talk about in this video about the Eurozone crisis, sort of the European portion of the global financial crisis in 2008, that similarly builds on the podcast that you've been asked to listen to about the Greek experience with the Eurozone crisis. So this video lecture really can't stand on its own without the required viewing and listening assigned for this week. So please do that first. And indeed, if you don't have time to do everything this week, do the Khan Academy videos first, do the podcast second, do me last, right? This is a case where I think the outside viewing and listening is actually more important than my recorded lecture. Okay, so once you've done that, let's talk about the Asian financial crisis kind of in a nutshell. Let's give the overview. So the videos track the Thai case really nicely, but this is kind of the big picture, right? So in the early 1990s, a lot of these economies in Southeast Asia, they opened up to inflows of foreign capital, right? And so foreign loans came in, a lot of investment took place, including particularly in real estate. There was a lot of speculative investment in real estate. And in particular, excuse me, um, you had a bubble in Thai real estate, right? So property prices in Bangkok went up 400% in just a few years, right? A lot of speculative money pouring into these office towers, into condo towers, that kind of thing. And then the economy started to slow and these asset bubbles collapsed, right? So when demand is driven, like if you take real estate in particular, when demand is driven by people who actually, firms that actually want to occupy these offices and people who actually want to live in these condos, when that's what's driving demand, that demand is fairly stable, right? It'll fall off, but it won't collapse. But when a lot of the demand is driven by speculation, by people who are only buying condos because they expect to be able to turn around and sell them 2 or 3 years later, or who are only buying office space because they expect to be able to turn around and sell it a few years later, that type of demand evaporates really quickly as soon as people don't expect prices to keep going up. So as soon as as economic growth kind of plateaued a little bit, then all the speculators fled the real estate market and real estate prices collapsed. Okay. So when that happened, there were a lot of banks, domestic banks in Thailand, Thai banks that had, and indeed across a lot of these Asian economies, a lot of banks had pending defaults on their balance sheets. So they'd made a lot of loans during these good times, and they were competing with foreign investors. So they were lending capital at attractive rates to firms and to individuals, competing with all these foreign lenders who are also dumping money into these economies. And then when things started to go down economically and firms started to fold, these banks were poised to take really large losses. Um, this set the stage for speculative attacks on currencies. And given the size of its economy and the fact that it had had one of the largest real estate bubbles, Thailand was the sort of the economy that got targeted first with a speculative attack, but it was hardly the only one. Um, and so the question is kind of like, why did the Thai currency succumb to a successful speculative attack, right? Because they had, in real terms, a lot of foreign currency reserves, right? Their peg should have been pretty safe relative to the size of their economy. Their government was holding on to a lot of U.S. dollars sitting in bank vaults, right? But the fact is, their economy, relative to the assets of all these foreign bondholders and stuff, relative to the foreign investors, the Thai economy is just fairly small. And their domestic banks were way over leveraged. They had borrowed money to lend out, so they were heavily leveraged. A lot of the loans on their balance sheets were bad loans that were never going to get repaid. And during this time, they'd been running a current account deficit. And actually, part of why they were running a current account deficit had to do with being pegged to the US dollar. And remember, when you're pegged to another currency, you aren't able to manage your current account deficit with competitive devaluation, right? You don't get to choose when to devalue your currency. And at this time, actually, the US dollar was appreciating vis-a-vis other currencies in Asia. And so the Thai baht, which was pegged to the dollar, was appreciating vis-a-vis other Asian currencies, particularly against the yen. And so this was making imports cheap in Thailand, so encouraging Thai citizens to buy a lot of imported goods. And it was also making Thai exports less competitive abroad, right? So discouraging exports. So they were running these pretty large current account deficits, which was then drawing on the dollar reserves that the government had and was putting them in this vulnerable position for a speculative attack on their currency. And when that happened, these crises are really rough, right? So, I mean, so Thailand, if you look kind of like from late 80s to early 90s, these are boom times. I mean, these growth rates are stratospheric, right? Up over 10% for 3 years in a row, right? And then, in this sort of 7, 8% range for another 4 years. So, I mean, in this time, if you sort of go kind of 1986 through 1995, right? The size of the Thai economy almost doubles in just in that short time period, right? So these are just boom times. But then the bust comes hard, right? And they have a year of slightly negative growth and a full year in 98 of less than 10%, of greater than 10% negative growth. So huge shrinking of the economy in just a year, huge unemployment. Really, I mean, these were really, really rough times. Okay, but fairly sharp, fairly deep, and then we bounce, but pretty much bounces right back, right? And you see the global financial crisis hit as well, but you have a pretty quick recovery after the Asian financial crisis. Okay, so when the successful speculative attack hit Thailand, when Thailand had to do had to break the peg with the dollar and devalue the Thai baht, as investors were pulling out of the collapsing Thai real estate bubble, they pulled out of pretty much the entire region, right? They pulled out of Malaysia, Indonesia, South Korea, the Philippines, right? And they did this for a few reasons, but largely due to contagion, right? There was fear that as soon as people saw the Thai real estate bubble bursting, they assumed that real estate bubbles in these other countries might start to burst as well. And these bubbles weren't quite as big, but they still popped really quickly. And so part of the way contagion works is that for foreign investors, research is really expensive. It's really hard to get down in the weeds of an overseas real estate market or an overseas equities market and really understand how strong the fundamentals are of the companies or the buildings that you're investing in. So investors take shortcuts. They look at what other people are doing. They lump similar countries together. And so when they see other investors start to pull out, or when they see bad things happen in a similar country next door, they head for the exits, right? Um, and so the Asian financial crisis, right? It's not called the Thai financial crisis; it's called the Asian financial crisis, right? It hit more or less the entire region, and these are losses in value of for Asian currencies, right? And the Thai baht, right, got hit quite hard, right? Lost about half of its value from sort of peak to valley, but the Indonesian currency got hit even worse. I mean, can you imagine when your currency loses 83% of its value? That means that the $100,000 you have saved for retirement is now suddenly worth $17,000, right? You've just lost 80% of your retirement savings in real terms overnight when your currency is devalued like that, right? Um, the stock exchanges around the region crashed from 97 to 98, right? So again, like if all of your retirement savings was in stocks, you're losing in some cases, 80%, in some places, only 40% if you're in Japan, right? So really, really rough collapses there. But it's a relatively short recession. So you've got kind of like from, 6 months in Singapore to a year and a half in Thailand and Japan of actually quarters with negative growth. And then there's a relatively sharp rebound afterwards. But what's the legacy of the Asian financial crisis? What came after that? So there was a lot of suffering, like because, it wasn't that long, but a year and a half, it was a brutal year and a half, right? And I don't want to downplay kind of the human suffering that went on during that time period. I'm going to talk about a silver lining here, but this was a brutal crisis, and it fell really heavily on the backs of the poor. There was a lot of deep human suffering here. The silver lining that did come out of it is that there was some austerity and especially caution that followed the Asian financial crisis. So some of the blame for the crisis was placed on, I think justifiably on the International Monetary Fund and the policy advice that they'd given in terms of opening up too far to foreign capital. But there was also a lot of sort of prudential regulation that followed, some of which was about capital controls, and some of it was about limiting the risks that the domestic banking sector could take. So that putting some restrictions in place that were going to make it harder for asset bubbles of quite that size to inflate again and for banks to become quite so over leveraged. And those more cautious regulations of the banking sector ended up serving the region very well during the global financial crisis. So Asian economies still got hit during the global financial crisis, but that was a crisis that was primarily centered in Western Europe and the United States, right? And Asia mostly got hit simply because Western Europe and the United States are large markets for their goods, so they got hit with decreases in exports, right? That some of their markets went away when our economies went in the tank in the West. But they, but in general, Asia weathered the global financial crisis much better, suffered much less damage than Western Europe and the United States. And some of that is due to kind of the legacy of the Asian financial crisis. They'd recently been through this and they were relatively well prepared. Okay, so we also want to talk about the Eurozone crisis, and we want to build on what was covered in the podcast that I had you listen to about the Greek context in particular. So, one of the things you heard on that podcast was you heard a number of Greek citizens talking about what it felt like to get access to credit for the first time, right? So, Greece was an economy where credit previously had been very, very expensive. So you could get credit, but you were going to be paying very high interest rates, 10%, 15%, 20% on a loan. And so people didn't take out debt for a lot of things. But when they joined the euro, suddenly they had access to much lower rate mortgages and car loans and boat loans and all these kinds of things. And so, that's a very fun time when you get access to credit for the first time because you can sort of do a lifetime's worth of deficit spending kind of all in a couple of years when you first get access to credit. And suddenly you have this ability to not have to only consume this year what you make this year. You can consume some of your future consumption, some of your future production as well. Um, okay. And you also, the other thing that was driving Greeks' individual decisions to take on debts during this time was optimism about the future, right? So part of this is that they had had no debt before, and moving from no debt to a sustainable level of consumer debt is a very pleasant experience as you enjoy that consumption. But they were doing some of this consuming future production now because they expected that in the future they would be richer than they were today, right? They were betting on rapid future economic growth, which wasn't an unreasonable expectation at the time they joined the euro. Many countries, when they first joined the eurozone, did then experience that rapid economic growth. Right, they had access to all these Western European markets. They were going to become integrated with these economies and sell their goods and services to these economies. Right, so so this wasn't a crazy thing to do to take on a bunch of debt. And of course, it's not just Greece that was taking on a lot of debt during this time, right? So this phenomenon is going on kind of throughout a lot of Southern Europe, right? There's a lot of optimism and a lot of deficit spending, right? Okay. And then when loss of confidence comes, right, it hits hard, right? So part of what happened was that it was revealed that Greece had lied about their balance sheets to get into the EU, right? So EU membership rules state that you have to have government deficits that are below a certain, that are not too large for a series of years and these kinds of things. And it was one of those things where the EU knew that the Greeks were lying on these balance sheets. Like there was definitely collusion around this. It was sort of like Greece would come to them and like give them the balance sheets and that would show that their deficits were too high for a series of years. And the EU would say, well, your deficits are too high. You're going to have to come back later after you've brought your deficits in line. And then Greece would go in and come back with new paperwork, which showed that, hey, you know what, actually we did some recalculations. We figured out actually our deficits aren't as big as we thought before. And the EU was like, oh, great. Well, then you meet the qualifications, right? Like they were told how to massage the data and they massaged the data they were told in the way they were told to do. Like this was, you know, eh, I think there's a lot of kind of sort of finger wagging on the EU side about, oh, we cannot believe that they were faking these numbers. It's like, oh, come on, you knew they were faking these numbers. You more or less helped them do it. So what was revealed, and kind of like shocked the markets, right, was that the Greek current account deficit was double what they'd been reporting, right? Now, the Greek government sort of denied these reports when they came out, and they actually there was a whole round of trying to throw their head statistician and some other people in jail for finally releasing the true numbers. Like, so it's not like this. It's not like the Greek government covered themselves in glory here either. Um, and so during this kind of turmoil, when it's not clear how the Greek economy is doing, how bad things are, and nobody's believing any of the numbers, right? It's really expensive for investors to do their own research. It's easier just to pull out of Greece. And when you're pulling out of Greece, like go ahead and pull out of Spain and go ahead and pull out of the rest of Southern Europe as well, right? So there was contagion in the Eurozone crisis as well, just as there was during the Asian financial crisis. Now, one of the things, sorry to have some of these things pop up here, not managing my tech very well. So one of the things that transpired, goodness gracious, sorry. One of the things that transpired was that, and we talked about this in our live session a little bit, where Germany was the major creditor nation here. They had loaned a lot of money, both, particularly German banks were doing a lot of lending in Greece, both to the government, but to private citizens. And so there's a lot of money owed by the Greek government to German citizens, to German banks, and Germany really wanted Greece to repay those debts and wanted the Greeks to repay those debts in euros that were highly valued, right? They didn't want devaluation and they didn't want debt forgiveness. And so if you're not going to have devaluation, you're not going to have debt forgiveness, and then Greece is going to have to repay their loans by raising taxes and cutting government spending. And that's really painful. And the problem is when you're already in a recession and then you raise taxes and cut spending, you drive that recession even deeper. So the economy becomes even smaller. So in order to get the same amount of revenue, you have to tax at an even higher rate, right? And this is sort of this pro-cyclical fiscal policy where you keep digging the hole even deeper, right? And I think in retrospect, most economists would argue that Germany should have engaged in more debt forgiveness or at least forbearance, where they allow loans to be repaid several years late. That they should have given the Greeks more space and more aid to rebuild their economy, because this sort of forcing austerity on the Greek economy in the way they did really drove the crisis deeper in economic terms, but it also, not super surprisingly, I mean, we definitely saw this during the Latin American debt crisis. All that austerity generated a lot of political instability, right? And you had a Greek government that was threatening to pull out of the Eurozone, right? To go off the euro, the Grexit, that they would go back on the drachma, that they would sort of give up the euro altogether. All these mass protests and mass strikes that's sort of making things worse, right? So, so this austerity in the Greek situation really did not work out very well. The recovery was very long and painful, and frankly is still ongoing, right? That more than a decade after the global financial crisis, Greece is still not in great shape economically. It's been a real tragedy, how that has played out. Okay, so that's what I want to cover in the videos for today, and I look forward to discussing this in class with you.